we looked at aggregate expenditures in the previous chapter, and in this chapter we're going to look at aggregate demand and aggregate supply and their relationship. So first up, we're going to look at aggregate demand. We're going to look at changes in aggregate demand, aggregate supply, changes in that. What is equilibrium and how can that change? So remember, just like before, when we talk about an aggregate, we're talking about all of the demand and all of the supply in an economy. So aggregate demand is your real GDP desired at each price level. And it's represented as a curve. And there's an inverse relationship between price level and output. As prices go up, output by rule is going to go down. And this relationship can be explained a little different than a single product. But remember, that's income and substitution effects. There's no substitution effect when we're looking at the entire economy, and income is varying with output as well, because once again we're looking at the entire economy. So what actually explains the fact that as price goes up, GDP is going to go down? Well, it's explained by three things. Your real balances effect is up first, or when price level falls, the purchasing power of existing financial balances rise, which can increase spending. So if prices are dropping, your money's worth more. And as a consequence, you can buy more goods and services. Interest rate effect as well. A decline in prices means that generally interest rates will be lower and you'll have more spending as well. And your foreign purchases effect. If our prices in the United States are going down and other countries aren't, it's going to make our goods and services more attractive for them to buy, increasing our exports as well as decreasing our imports. If our prices are getting cheaper, there's no reason to import things because we can just buy the goods and services that we make in this country. So in this case, those are all of the reasons it is inversely related. And once again, we can look at it plotted graphically right here. And there's your demand curve. And as price is going up, output is going down and vice versa. Lower prices, more output. This is why severe inflation can lead to a recession in an economy, because it has a large impact on the overall amount of output. So what can change aggregate demand? So aggregate demand can change with anything affecting the components of demand. Remember, consumer spending, business investment, government spending, and trade balance, or the difference between exports and imports. And you can have two components. Number one of these things gets altered, and then it's subject to your multiplier effect. And as a consequence, it's either going to increase or decrease overall demand. If we look at this curve here, remember when we speak about aggregates, we're talking about the entire economy. So if those external factors are altered, you can either have more demand, which is going to be line number 2 right here, or you can have less demand, which is line number 3 right here. The dashed line is the initial change in spending, and then the solid line is once it's been subject to the multiplier. So remember, consumer spending is determined by the following things. Number one is consumer wealth. The more wealth you have, the more you are going to be able to spend. The ability to borrow. Remember, you can spend more than your income if you are borrowing, and we looked at that when we saw negative savings. So depending on borrowing, and borrowing is usually subject to interest rates, expectations, all of that stuff. Consumer expectations is a big one. If you think the economy is going to do very poorly very soon, you're probably going to cut your spending right away. Vice versa, if you think it's going to do well. And taxes, if taxes go down, spending goes up. If taxes go up, spending goes down. Pretty straightforward. As for investment spending, remember that is determined by interest rates and expectations. So as interest rates are changing, that's going to greatly affect investment spending. higher interest rates, less investment, lower interest rates, more, and then our expected returns. We don't just do investing for no reason. We do investing to make money. So expectations about future conditions. If you think we're about to go into a terrible recession, you probably would not be making large investments right now. If new technologies come out, we're probably going to make investments. Remember, investment generally tracks technological change. As new technologies come out, we generally greatly invest into them. Changes in excess capacity. If there are a lot of unused capital goods, we're probably going to invest less. If we need more capital goods, we'll invest more. And taxes, same effect. If business taxes are going up, they're going to have less money to invest. If they get a tax cut, they'll have more. If we look here at government spending is going to once again be similar. So in the case of government spending, if the government spends more and everything else is held equal, the overall demand should increase because you have all the private demand and now the government's putting their own demand in. So one example would be more transportation projects. The government decides to build a bunch of bridges. That would be government spending in addition to all of the other spending we already have. If government spending decreases, it should drop demand. So if they spend less on the military, for instance. And as for our trade balance, remember what is subject to this. So national incomes abroad mean how well are our trading partners doing. Let's say we trade a ton with the United Kingdom and their economy starts doing very poorly. That should put a big dent in our exports. So if the countries we export to are not doing well, if their income is going down, it's going to hurt us. As for exchange rates, remember, if your currency is strong, it makes it unattractive for countries to buy your goods and services. If your currency is weak, it makes it more attractive. The reverse happens for importing. If you have a really strong currency, it becomes very attractive to import because it's like you're buying everything at a discount. If you have a really weak currency, it is not attractive to import. So that was everything for aggregate demand. And let's take a look at aggregate supply. Aggregate supply is similar to aggregate demand. It's just the other side of the coin. Only with aggregate supply, instead of once again one product, we are now talking about all of the supply present in an economy. So aggregate supply is the total amount of real output produced at each price level. And we have 3 time horizons we can look at. Now, why do we have multiple time horizons? Remember, over enough time, prices can change. Where in the short run or so, they can be very, very fixed. So first up, we're going to look at the immediate short run, where both the prices of input and outputs are fixed. Your input prices can be fixed by things such as labor contracts, so you have to pay your employees a certain amount for a certain amount of time. And output prices are generally fixed because of advertising, catalogs, price lists, all of that stuff. You can't just change your price right away. So in the immediate short run, we say that supply cannot change price whatsoever. It is fully fixed. In the regular short run, your input prices are fixed, meaning your resources and your labor and all of that, but your output prices are variable. That's our short run. And finally, in our long run, or over a long enough amount of time, both input and output prices can change. One thing to take away from this course, as I said previously, in a long enough amount of time, all prices can change. So in a long enough amount of time, all prices can change. So here is our short run curve right here. So as you can see here, price does not change. So supply is a flat line. And depending on demand, the quantity will change. So firms will collectively supply the level of output demanded at that price. So we can move along that flat line. Quantity will change. Right now we're at QF, but supply will not. Supply will not. So the quantity supply to the market will not change. The quantity demanded, or QF, that can move based on demand. So if demand is dropping or increasing, prices can't change and supply cannot change as well. We have a flat line. In the short run, and this is the curve we generally look at, we're dealing with a curve that upward slopes the opposite of our demand curve. So this is the aggregate supply curve we usually look at when we are looking at equilibrium and all of that stuff. So in this case, our supply can change based on price, and it is upward sloping. So it's relatively flat below full employment output, or QF. That's where we want to be, because unemployed resources and unused capacity allow firms to respond to price level rises with large increases in output. It becomes relatively steep beyond this, because what happens once you are at your full employment capacity? Can you exceed it? Yes, but it's generally not sustainable, remember. It becomes incredibly costly, it can lead to inflation, all of that stuff. Because resource shortages, capacity limitations, the inability to find more workers, it makes it difficult to expand output as the price level rises. Aggregate supply slopes upward with input prices fixed. Rising prices increase profits, declining prices decrease them. So in this case, price can change. Price can change. And quantity can change as well. In the long run, so in a long enough amount of time, supply becomes a vertical line. And the reason it becomes a vertical line is we will find the optimum quantity and we'll never change from it. We'll just vary price. So in the long run, your aggregate supply curve is vertical at full employment real GDP at QF, because in the long run, wages and other input prices rise and fall to match changes in overall prices. So in a long enough amount of time, we can change what we pay our employees and what we pay for our inputs. So in a long enough amount of time, supply will become a vertical line where the economy will produce at that optimum quantity, or QF here, and the only thing that will change is our price. So in the long run, the economy will produce the full employment output level, no matter what the price level is, because profits will always adjust to give firms exactly the right profit incentive to produce exactly the full employment output level. Remember that full employment output level is the only sustainable level long term. So what can shift aggregate supply? Well, this is similar to aggregate demand, and in this case we're going to look at the short run curve, and let's take a look. So just like with demand, we have situations where the entire supply curve could move. So now we have more supply at all prices or less supply at all prices. And one can do this. And as we looked at before in previous chapters, if you move along a curve, it's a function of price. If your entire curve moves, like we're seeing here, it's a function of some sort of external factor. So what can do this? Well, up first are our resources. Remember, as our resources get more expensive, we are going to have less overall supply for one good or service or the overall economy. So if labor, capital, and land are becoming more expensive, supply is going to shift in, like we saw on the previous slide. If they're becoming cheaper, they're going to shift out. Same thing with our imported resources. Many goods and services require imported resources to produce them. So if oil is getting more expensive that we're importing from other countries, we're going to have less supply. If it's getting cheaper, we'll have more. Exchange rates, same thing here. So if the dollar is becoming stronger, we can buy our imported resources more cheaply, and that's going to increase supply. So this is the opposite of demand. If our dollar is becoming stronger, we'll have more supply, because now we can buy foreign oil or lithium for batteries from another country or anything like that at a cheaper price. Whereas if our dollar is doing badly, the exchange rate goes the other way, it's going to decrease overall supply. It's going to raise our production costs. Because most goods and services in today's world do require some sort of imported resource component. What is productivity? Well, productivity is your real output per unit of input. So to calculate it, you might see a question asking to calculate it. It's your total output over your total inputs. So becoming more productive is a good thing. It means we can make more for less, and it'll drop your cost. And the more productive you are, the cheaper you can make. The less productive you are, the more expensive you can make. And this is why things generally get cheaper over time, technological products, etc. We become able to make them at a lower cost because we become more productive. Our per unit production cost is just our total input cost over our output. How much does it cost to make each unit? So if you see a question on one of those, it's just simple division. Finally, legal changes can alter your costs as well. So taxes and subsidies, pretty straightforward. If taxes go up, it's going to increase our costs. If they go down, decrease them. If government subsidies get created, like Tesla is getting subsidies to build battery plants, for instance, it's going to decrease their costs. If subsidies go the other way, it's going to increase their costs. So if we look here, equilibrium level and equilibrium real GDP, well, what we're looking at in this curve here is at 510 billion, that is our equilibrium point for our economy. So just like for individual products, it's where our supply and demand lines cross, only these are the aggregate ones, or all of the supply and all of the demand in the economy. So at a price level of 100, we are manufacturing $510 billion worth of stuff, and that's what's being demanded as well. So we have perfect equilibrium. So we strive for equilibrium in all things. So all of the supply and all of the demand, that is equilibrium GDP, like we looked at in our previous chapters, where all the goods and services in an economy are being consumed. Everything being produced is being consumed. So why can we get demand pull inflation like we just saw? So if we look at these lines right here, we're moving from demand curve 1 to demand curve 2. If you follow the green arrow up top. And what happened here is now we have a lot more demand in an economy. And this could happen like we saw after COVID, where all of those relief money checks went out and now people had all this extra money to spend. And when this happens, supply isn't really going to change right away. So you're just moving up the supply curve, and as a consequence, everything gets more expensive. If supply is the same and demand goes up, think back to individual products, our overall cost is going to become more expensive. So this is what we saw in 2021. This is what we saw in 2021. This is what we saw in 2021. And as a consequence, we wound up with a large amount of inflation as a result. So we should move from point A to point C at a lower equilibrium. But what actually happens here is the following. Demand is dropping from 1 to 2, but price cannot go down. So we're still at price 1, and as a consequence, we wind up in a recession where we are no longer at equilibrium. We'll have excess quantity because price won't go down, and this will then lead to people getting laid off, unemployment, idle production capacity, a recession, recessionary GDP gap, all of the stuff we looked at. If prices were flexible on the way down, we would simply move from equilibrium A to equilibrium C. So recessions, remember, are generally caused by the fact that prices don't adjust very well on the way down, for all of the reasons we looked at already. And we're going to look at them again. Why does this happen? Once again, we looked at this in previous chapters, but fear of price wars, number one. Businesses generally don't engage in them because they're very harmful and can cost them a lot of money. Menu costs, what we mean by that are posted lists of prices, catalogs, advertisements, what you tell your consumers if you're a supplier, what their things will cost. Those are all menu costs. Wage contracts, that's the big one. Remember, we can't just simply keep cutting our employees' salaries. There may be legal reasons why. There may be minimum wages. They may have contracts. Or simply, even if you can, they may just simply quit. That's what we mean by efficiency wages. Generally, we pay our employees enough money that they want to actually work for us. If we keep cutting their salary, they're probably going to do the absolute bare minimum, and as a consequence, you actually lose more money than paying them a better wage. And finally, there are legal minimum wage laws and union contracts and all of that stuff where you can't actually cut someone's salary beyond a given point. If we look here, this is the deviation of actual from potential GDP in 2017. Remember, you can exceed your potential GDP. It's just usually not sustainable. It generally corresponds to inflation. And if you're deep into the negatives, it means that you're either in a recession or were recently in one. Greece at this time was in very bad economic straits, for instance, and in a severe recession. Now, if we look at this one, this is an example of cost push inflation. And by cost push inflation, we mean the following. Cost push inflation is caused by a decrease in supply, and demand didn't change. So now you're moving from point A to point B on the demand curve, only the supply curve is going from 1 to 2. So now we have less supply, and we're on the same demand curve. Demand didn't change, so price is adjusting up from 1 to 2. We saw this recently with things like the computer chip shortage and the used car shortage and all of that. Demand for these products didn't change. There was just a reduced supply of them, and as a consequence, prices greatly increased. So that is cost push inflation. Our last example here is what we saw in the 1990s, and this is an example of healthy growth. So in this case, both our supply and our demand curves moved. So our demand curve moved quite a bit in the 1990s. Incomes were rising. It was a very good economic time. So prices should have moved from point A, price 1, to point B, price 3, which would have given you quite a bit of inflation. Only not only did the demand curve move, the supply curve moved as well from curve 1 to 2. And our prices really only changed from point A to point C. They barely went up. This is an example of healthy growth. Your growth is because you're becoming a lot more productive, as well as salaries are going up. So in addition to more demand, you're going to get more supply as well. So there's not going to be that great of a change in prices. This is something very good. Whereas if we move from point A to point B, that is your demand pull inflation. So that's the difference between stable growth, where prices don't change very much, inflation's very mild, or heavy inflation like we just recently saw. We're going to end this chapter on, once again, what happened during the Great Recession in 2007 through 2009. So that recession, the short version was, bad loans were given by banks and it caused the base to houses. The housing market collapsed because it was overvalued, and the banks that wrote these loans started failing. Now the Federal Reserve intervened and they started cutting interest rates and also doing massive government spending. And we credit these actions as preventing something like a depression, but the recovery after that was quite slow. And we want to know why specifically it was. And if we look here, there's a few reasons you could argue. Number one, the growth in GDP after all this government spending and low interest rates done by our central bank, the Fed, who we'll touch upon quite a bit more in the last few chapters, was really disappointing. And you could argue it was both due to things like a lot of people were already in a lot of debt because interest rates were cheap. And when people are in a lot of debt, it generally puts a damper on growth because you have to pay that debt back. Recessions cause also high rates of savings. Now this is a good thing for individual people, but not necessarily in a growth sense. The reason being, think about what just happened with the COVID shutdowns. A lot of younger people really started exhibiting this. Savings rates shot up. When shocks scare people, so something like what we saw during COVID or what we saw during the Great Recession, people generally will sock away money in case that shock happens again. So shocks scare people, and as a consequence, what they do is generally lead to more savings. So as a consequence, that will put a damper on growth because what is saved isn't going to be spent. And there was an unequal impact. Certain parts of the economy grew very well and other parts didn't. And we also saw price increases rather than output gains. So not always do we see like what we saw in the 90s, where if there's more money, supply is going to go up as well. A lot of times you'll see what we just saw here in about 2008-09, and also in right after COVID, where we did similar stuff. The government spent tons of money and issued rebate checks and all of that. A lot of times what we do see is prices just simply go up rather than companies make more or become more productive. And we'll touch upon a little bit more why that's the case in the next few chapters. So that's going to bring us to the end of Chapter 12, Aggregate Demand and Aggregate Supply.